What if America never truly recovered from the Great Depression? What if everything you've been taught about 1929, the crash, the panic, the reforms was only the surface of a much deeper design? What if the collapse wasn't the end of the story, but the beginning of a blueprint? A blueprint so effective, so profitable, and so quietly engineered that Wall Street spent the next century perfecting it. There's a hard truth buried beneath the official history. The reason so many Americans feel financially squeezed today, crushed by inflation, weighed down by debt costs, is because the same financial structure that collapsed the economy in 1929 is the very structure regulating your life in the present. The suits have changed. The language has changed. Technology has evolved. But the underlying playbook is identical. Behind the curtain of America's financial system lies a machine polished, optimized, and hidden in plain sight. A machine made of invisible credit, synthetic liquidity, complex derivatives, and off-book entities that allow a handful of institutions to move money, create risk, hide exposure, and engineer crises at will. Before we dive deeper, one quick check-in. Where are you watching from? I love seeing this community grow from every corner of the world. And if you're new here, make sure to subscribe, because this is one of the few places breaking down the unfiltered truth behind America as financial illusions. To understand how this blueprint works, we must go back to the roaring 1920s, a decade often portrayed as glamorous, prosperous, and unstoppable. Jazz clubs flourished, automobiles filled the streets, and consumer spending exploded. But beneath the glamour lay a system already cracking. Wall Street had discovered the intoxicating power of leverage, borrowing money to multiply bets, borrowing again to multiply the multipliers. By 1929, margin trading had exploded by over 500%. The average speculator could buy stocks with 10% cash and 90% borrowed money. Banks were handing out loans like candy. Regulators were asleep. Optimism drowned out caution. Sound familiar? Because the modern economy operates on the same principle, just hidden inside complex financial instruments. Today, leverage is embedded in derivatives, credit default swaps, structured debt obligations, and algorithmic strategies that amplify risk far beyond what the public sees. Leverage never disappeared. It simply went underground. In the 1920s, banks formed secret pools, informal alliances that manipulated stock prices, pumped shares, and dumped them on unsuspecting traders. These pools were opaque, unregulated, and deeply corrupt. Again, sound familiar? Today's versions are called dark pools, offshore investment vehicles, and special-purpose entities. They perform the same functions, hiding risk, concentrating wealth, and enabling coordinated manipulation. The crash of 1929 didn't happen because everyday Americans were irresponsible gamblers. It happened because the system itself was engineered on illusion, a towering structure of debt and insider manipulation that collapsed under its own weight. When the fall came, $14 billion vanished in a single day. Yet Wall Street, new laws were drafted. Confidence was restored on the surface. But behind the scenes, Wall Street wasn't ashamed of the crash. They were inspired. They realized the incredible profitability of controlled chaos, how regulation could be sidestepped, and how the public could be convinced that reforms have fixed the system even as new loopholes quietly formed over the next 9 decades. Every crisis became a stress test for innovation. Every bailout became a signal. Every regulatory gap was exploited. Slowly, methodically, Wall Street built an empire far more powerful than anything that existed before the Depression. By the 1970s, financial engineering created a new universe of synthetic products. By the 1980s, deregulation opened doors that had been sealed for decades. And by the 1990s, the rise of structured finance turned risk into a commodity, something to repackage, sell, insure, and disguise. Long-term capital management collapsed in 1998 after making $1.25 trillion in derivative bets with only a few billion in actual capital. A single fund nearly took down the global financial system. But instead of reforming the structure, Wall Street learned from it. They upgraded their playbook, because 10 years later, the same architecture collapsed again, bigger, faster, and more devastating. The The 2008 crisis was powered by the same ingredients: leverage, opacity, and synthetic risk embedded across the entire system. Subprime mortgages were simply the spark. The real fire was the complex, intertwined web of derivatives behind them: credit default swaps, synthetic CDOs, and counterparty chains no regulator could see. When the flames spread, ordinary people lost homes, jobs, and savings. But the institutions that engineered the disaster, they were bailed out. They expanded. For decades, this blueprint operated quietly in the background until a subtle loophole emerged in the 1980s, unnoticed by the public and barely understood by regulators. That loophole changed everything. It allowed banks to create an entirely separate universe of credit, one that didn't require customer deposits, didn't require reserves, and didn't require supervision. A universe that operated outside the traditional banking system, yet controlled nearly all of it. This was the birth of something unprecedented, a hidden empire made of synthetic money, a financial shadow world, the shadow banking system. Through this structure, banks no longer needed deposits to lend. They created liquidity through repurchase agreements, securities lending, and above all, derivatives. Complex, opaque contracts that could replicate almost any exposure, hide almost any risk, and multiply leverage far beyond what anyone could see. Derivatives became the engine. Shadow banks became the vessels. The public became the collateral. By 2007, the notional value of global derivatives ballooned to $600 trillion, more than 10 times the entire global economy. This system did not reduce risk. It hid it, and the architect who helped unleash the deepest wave of deregulation, whose signature decision opened the gates to the modern derivatives universe. Because behind this door lies the clearest proof that the blueprint from 1929 was never destroyed. And the receipt is wilder than you think. Have you ever wondered where the real money in the world is? It's not in the banks you see on the corner. The truth is, shadow banking isn't some fringe part of global finance. It's the hidden core. Traditional banking seems simple, right? You deposit money, the bank lends it out, and that cycle fuels the economy. But the shadow system bypasses all of this. It operates in a world where credit can be created without deposits, money can be synthesized without any oversight, and liabilities can be hidden without consequences. So how does it work? It all starts with something called off-balance sheet entities. Big banks create these legally separate companies, like SPVs and SIVs, for one single purpose: to hold risky assets without them ever appearing on the bank's official books. These entities then borrow money by issuing securities, which investors often using borrowed money themselves snap up. Then comes the magic trick: derivatives. These complex financial instruments are used to insure or repackage these risky assets until they look completely safe, even when they're anything but. It's a mathematical disguise. A toxic subprime mortgage, after enough slicing and dicing, suddenly becomes a AA-rated bond. A failing corporation looks stable once it's propped up by credit default swaps. By 2007, this shadow system was creating over 60% of all global liquidity. Think about that. More money was flowing from these hidden channels than from all the traditional banks combined. Yet, none of it was insured. None of it was backed by reserves. And almost none of it was visible to regulators. It was a global tower of promises, with every single block borrowed, reused, and repledged multiple times over. In some cases, a single piece of collateral, like a treasury bond, was used to back up to 30 different loans in one chain. $1 of real value was supporting hundreds of dollars of synthetic exposure. Now, a structure like this is incredibly fragile. One break in the chain, one missed payment, one failed hedge, one company going under can trigger an uncontrollable collapse. And that's exactly what happened in 2008 when Lehman Brothers fell. The connections between financial institutions snapped like power lines in a hurricane. Markets froze. Liquidity vanished. The world lost nearly $50 trillion in paper wealth overnight. But here's the most disturbing part: the system's architecture survived, because destruction is part of the design. In this system, the very institutions that caused the collapse are the ones who benefit from it. Crisis becomes opportunity. Distress becomes profit. They swoop in and buy up assets for pennies on the dollar. Entire industries consolidate. Smaller players get wiped out. Power becomes even more concentrated at the top. And who pays the ultimate price? Ordinary citizens. Every single time. The engine that keeps this shadow universe running is called the repo market. In these repurchase agreements, institutions lend each other money overnight, using securities as collateral. But because that collateral can be reused endlessly, the same asset can back a massive chain of loans. This means the entire global financial system isn't running on real money, it's running on trust. And if that trust evaporates, so does the money. This fragility is intentional. It creates a situation called moral hazard on a scale we've never seen before. When the risky bets pay off, the institutions keep the profits. When the bets fail, the public is forced to absorb the losses through bailouts. Regulators are blinded by the complexity of it all, and central banks have no choice but to rescue the system to prevent a total meltdown. The illusion feels stable until suddenly it isn't. If you look back through history, the pattern is unmistakable. In the 1920s, leveraged stock pools pushed markets to insane heights before the Great Crash. In the 1990s, the hedge fund LTCM used exotic derivatives to place trillion-dollar bets that nearly brought down the system. In the 2000s, synthetic CDOs multiplied mortgage risk far beyond the housing market. And today, in the 2020s, algorithmic strategies and swap-driven liquidity dominate everything. The tools change, but the blueprint is exactly the same. Every cycle ends the same way. Credit expands artificially. Risk is hidden. Profits are extracted. A collapse occurs. Wealth transfers upward to the powerful. And then, the cycle restarts. The numbers alone reveal the scale of this illusion. Before the 2008 crash, there were $600 trillion in derivatives. During the 1929 collapse, $14 billion were wiped out in a single day. The small hedge fund LTCM had $1.25 trillion in exposure. 60% of global liquidity was created in the shadows. Collateral was being reused up to 30 times. These statistics aren't just warning signs. They are the system's operating manual. The institutions at the center of this are not fringe players. They are the largest, most powerful names in global finance: JP Morgan, Citigroup, Goldman Sachs, HSBC, Deutsche Bank, Barclays, and massive asset managers like BlackRock that control the pipelines of collateral. They don't really compete with each other in the traditional sense. They are interdependent. The system requires their shared secrecy and mutual survival. If one of these pillars collapses, the entire structure trembles. If several collapse, the world economy faces an existential crisis. And here's the sobering truth. The shadow system didn't shrink after 2008. It grew. Today, the global derivatives market is estimated to be over $1 quadrillion in notional value. That's a 1 with 15 zeros. It's an astronomical figure built on synthetic promises that makes the Great Depression look small by comparison. This system is now global, instantaneous, and algorithmic. One mispriced financial product, one frozen repo market, one failed counterparty could trigger a cascade far faster and more devastating than anything we saw in the 20th century. The next crisis won't be contained to housing or banking. It will be systemic. It will hit every market, every sector, and every nation, all intertwined in the same web of shadow liquidity and synthetic credit. This didn't happen by accident. It happened by design. A system built on borrowed time and borrowed trust always ends the same way. Collapse isn't a malfunction. It's a scheduled event. The only question is when. But the deeper danger is philosophical. When a society believes in illusions for long enough, it forgets how to recognize reality. When a public trusts institutions without questioning them, it becomes dependent on systems that are literally built to fail. This blueprint isn't just financial, it's psychological. So before we finish, I want you to consider one question. Are we any wiser today? Or are we just walking down the same path, but in better suits? If this breakdown opened your eyes or helped you see the underlying design of our financial world, share your thoughts in the comments. Spread this message. And subscribe for more content that looks behind the curtain. The more people who understand this structure, the less power its architects will have when the next shock arrives. Stay skeptical, stay aware, and stay prepared.